Hello, this is Prof. Aram, and in this video, I'm going to provide an overview of the three main forms of business organizations, namely sole proprietorship, partnerships, and corporations. So let's get to it. The first one that we will look at is going to be sole proprietorship. This is a business that is owned and operated by a single owner. And usually the owner gets to keep all the profits, but it's also responsible for all the liability of the firm. So there's an unlimited liability aspect to this. And the owner usually, in the beginning, uses his or her own capital to start a business and maybe borrows some of the money from the bank. An example of this is like a local restaurant or a mom and pop store in your neighborhood. The advantages of a sole proprietorship is that it's very easy to form. There aren't many red tapes when it comes to forming a sole proprietorship type of business. And as the sole proprietor, you are the sole decision maker of the business. So you don't have to get permission from your shareholders or from regulators or so on and so forth. So you're the sole decision maker of the business, which makes the decision making more efficient and faster. And of course, all the profits are going to be taxed at your own tax rate, your own personal tax rate. And in terms of disadvantages, is that you have unlimited liability, meaning that if you are not able to meet your contractual obligations, if you're not able to pay your interest and principal on a loan, the banks can come after your business. And if the assets of the business are not enough, then the bank can go after your personal assets, like your house, your car, or whatever that you own. And then another disadvantage is that because usually you use your own capital or you borrow from a bank, it's the amount of capital available to sole proprietorships is usually very limited. And then the main disadvantage is that the business dissolves after the death of the owner. Let's say the children take over the business. It is the same business, but it's not going to be the same sole proprietorship entity, right? It's going to be a new sole proprietorship, which is under the control of the children. The next form of business is a partnership. That is when two or more entrepreneurs join to start a business as co-owners. And we have two types of partnerships, the general partnership and the limited partnership. In a general partnership, all partners are actively involved in running the business. And because of that, all partners have unlimited liability. On the other hand, in a limited partnership, and two or more partners are in charge of managing and running the business, and the rest of the partners, they just provide the capital. They're kind of silent partners. And because of that, as the name implies, limited partners have limited liability, whereas the general partners have the unlimited liability as before. In terms of advantages and disadvantages, usually similar to sole proprietorship, the advantages are that it's relatively easy to form still, and the business is taxed at the personal income tax level of a partner, and then capital is contributed from multiple partners. In other words, because it's a partnership, because more people are involved, more people can be injected into business, right? So that's an advantage. The disadvantage is, first of all, you have unlimited liability for general partners, and then it's very difficult to transfer the ownership because when you want to sell your share of the partnership, your best option is to sell it to another partner in the same business because it's usually hard to find someone who's interested in that business that you're in. Usually the partnerships are set to be very customized based on the needs of their customers and the partners. So it's really hard to find a buyer for your share of the partnership unless another partner is willing to buy you out. And then finally, we are looking at a corporation form of business. So at some point in the life of some firms, the growth is so fast that the owner's capital or other investors' capital is not enough to finance that growth, which means that the owners, the founders, and the other investors decide to go public. We call this initial public offering. So I'm going to have a video in the later time to explain this process. But for now, just imagine that you own a private firm and you sell a portion of that private firm to individual investors outside the firm through the initial public offering or IPO process. So doing this, going through the IPO, is motivated by raising capital, motivated by your need to have more capital to finance your growth. So, and keep in mind, in this type of business, in the corporation, there's a separation between the owners and managers. There's a separation between the owners and the company. For example, if I own a share of Apple and I sell my share, doesn't change anything about the company itself. Apple is still Apple. It's just my share is now owned by another investor. So the corporation itself is separate from the owners of the company. And also keep in mind that the corporation is a legal person and have the same rights that a natural person has. They can own property, they can borrow money, they can sue someone, or they can be sued. So they have basically almost every right that a natural person has. It can even own the stocks of other corporations. So it's a very interesting type of business. In terms of advantages and disadvantages for a corporation, the advantages are you have limited liability as a shareholder. So let's say you buy $10,000 worth of shares of Apple or Facebook or whatever company that you want to buy. And if these companies go bankrupt tomorrow, all you're losing is that $10,000 you invest in these firms. So you have limited liability. Nobody's going to come after your personal assets. The second advantage is that it is efficient and easy way to raise capital, especially if you want to raise a huge sum of capital. An IPO is the best way to do it. Forming a corporation is the best way to do it. And as I mentioned before, because of separation of the ownership and corporation, it has unlimited life. So if a shareholder dies today, let's say you own a share of Ford company, and a shareholder dies today, nothing happens to the corporation. Your shares are just going to be transferred to the heirs of the shareholder, right? So the company itself is going to run the same as they basically operated before the death of the shareholder. So there's an unlimited life for these corporations. In terms of the disadvantages, of course, they're harder to establish because they're more regulated. Whenever a firm or a corporation deals with individual investors, regulators are involved. Regulators want to protect the rights of the individual investors. That means that if you want to establish a corporation, you have to file paperwork with several regulators. In different countries have different regulators, but here in the US, for example, you have to file paperwork with SEC, Security Exchange Commission. And then you have to meet some requirements from the exchange as well. So if you want to basically list your company in New York Stock Exchange, you have to meet the requirement of the exchange as well. It's harder to establish, and staying public, staying a corporation, staying a public company is also costly because you have to basically on a regular basis, you have to file paperwork, you have to disclose information to the regulators, and it's costly for the firm. So these are the advantages. The second advantage is the double taxation. So when you look at a simple income statement of a company, you'll start with the sales and then cost of goods sold. goods sold, and then depreciation, right? You have your EBIT minus interest, which is your taxable income, minus tax, it's your net income. And the net income can be used either to pay dividends, or you can keep the money in the firm and add it to the retained earnings of the company. So by double taxation, what we mean is that you pay taxes once at a corporate level, and then the same dollar is going to be taxed again here when you receive dividends. You basically, this is the first tax you pay, and the second tax is the personal tax you pay on the dividend. So this double taxation is another disadvantage of the corporations. And finally, I mean, there are ways, like for partnerships or for sole proprietorships, you can form a limited liability company, which gives you the tax benefit of a partnership, meaning that you're going to be taxed at your personal income tax bracket. Plus, it gives you limited liability feature of the corporation. So LLC is the one way to get around the unlimited liability of partnerships or sole proprietorships. Okay, I hope you find this video useful, and thank you very much for watching.